Hi everyone, welcome back to Saheb Academy. Today in the sixth video of depreciation chapter, we are going to understand the remaining two accounting treatments of disposal or sale of property, plant and equipment. Yeah, these two, case 3 and case 4, and we are also going to solve problem on this, isn't it? Because that's what is left over here. In the fifth video, what did we do? We started the topic called as disposal or sale of property, plant and equipment, isn't it? What does that mean? It means when you sell your tangible fixed asset, right? When you do that, what you have to do from the accounting perspective, that is what we understood. And what was that? Three things you have to do: charge the depreciation, calculate the WDV, or you can say book value or carrying amount on the date of sale, and then you have to calculate profit or loss which has been made because of that transaction, right? Three things you have to do: charge depreciation, calculate WDV, and the third thing is calculate profit or loss on sale or on disposal, isn't it? Yes. Now one thing you have to understand over here, see here three cases can happen in depreciation. If you are selling the asset in the beginning of the year, then there will be no depreciation. But if you are selling the asset at the end of the year, then what will happen? Entire 12 months depreciation you have to charge, because you had the asset for the entire 12 months. But 99% of the time what will happen? You will sell the asset in between the year. If you're selling in between the year, then you have to charge proportionate depreciation. For example, if you have used the asset, if you had the asset for 5 months and then you sold it off, let's just say on 1st September, if the 1st April is the beginning of the year, then you have to charge 5 months depreciation. Is that clear? This is what you have to do. Fine. So this is what we did, and in the previous video we saw these two cases of accounting treatment, yeah, without provision for depreciation or accumulated depreciation, and without asset disposal and with asset disposal. Yeah, both of these cases we have understood properly, and we have also solved problem on this. It's really simple. It's the same thing actually. Little bit differences are there. You have to understand that properly. And I told you the most practical and the one which is followed in real life is the case 4, where you are maintaining provision for depreciation or accumulated depreciation account, and when you will sell off the tangible fixed asset, you will also maintain this, you will also open this asset disposal account, right? So let's just start this video and let's understand what is this case 3 and case 4, and let's solve problem on both of these. Okay, let's begin. Now see, here we have case 3 accounting treatment of disposal of PPE. That is when you are maintaining provision for depreciation or accumulated depreciation account, but you are not opening asset disposal account when you sell off your asset. Okay, case 3. Is that clear? Simple. So let's start. See, here we have the journal entries, and then we'll see the ledger accounts, and then we'll move on to a problem. Fine. Okay, first see the purchase journal entry over here, which is exactly same. Asset account debit to bank account, no change at all. And then we have depreciation entry, which is also exactly same. When you are maintaining the provision, what happens? You have to credit the provision account or accumulated depreciation account. You do not credit the asset account. So what will be the journal entry? Depreciation account debit. You have recorded the depreciation expense, and you have to create a contra asset account, yeah, which acts against the asset, which offsets the asset. Yeah, that's what a contra asset is. So we create a contra asset over here. Yeah, the name of that contra asset account over here is accumulated depreciation account, or you can say provision for depreciation account. Is that clear? Simple. Now this entry will be passed twice. Understand this properly. I have also told this in the case 1 and case 2 also. Depreciation you will be passing twice. The first is on the date of sale. When you sell the asset, you have to charge depreciation on that. And this is how you charge the depreciation now. Yeah, so you'll be charging the depreciation on the date of sale. And then the second thing is whatever remaining asset you still have at the year end, on those also you have to charge the depreciation, and that will be at the year end, at the end of the year. Is that clear? So 2 times you'll be passing this entry, 2-time posting will be happening. Fine. And then transfer to P&L. Now what is this transfer to P&L? You all know depreciation is an expense account. What do we do with expense and incomes account? We always close them at the year end. Whatever balances we have, we close them and we take that to profit and loss account. Here depreciation was debited twice. So now here you will credit it by the sum of those two amounts. Yeah, let's just say 9,000 and 1,000. So 10,000. So 10,000 you will credit the depreciation. Yeah, so depreciation account is eliminated. It's cancelled. That's how we cancel things in accounting. First it was debited, you credited it, it got cancelled, and then you debited the profit and loss. So in profit and loss account, 10,000 expense has gone as depreciation. Is that clear? Right. So that's the transfer to P&L entry. And then come to the main part, that is the disposal. Now what is happening in disposal? Here in disposal you have two entries. Okay, on the date of sale actually you'll be passing three entries, isn't it? One entry is over here now, the depreciation entry. You have charged the depreciation on what? On the asset which you have just sold. Now here what's happening? What is this? Accumulated depreciation account debit to asset account. What is happening over here? You have to understand properly. See, what you have to do is, whatever depreciation you have charged up till now, up to the date of sale, yeah, that depreciation will be in accumulated depreciation. So that depreciation you have to cancel off. That accumulated depreciation you have to cancel off. For example, let me just give you an example. Let's just say, for example, you have sold off an asset after 3 years, okay, and let's just say they were following straight line method. So 1,000 depreciation annually was there, just for an example, 1,000. So 1,000 into 3, so that's equal to 3,000 depreciation has been charged up till now. 3 years has been passed. You were using the asset. In the end of the third year, at the end of the third year, you have sold off the asset. So 3,000 depreciation is there up till now. So this 3,000 depreciation is existing where? It is existing in this provision for depreciation account, or accumulated depreciation account. So you have to cancel that. If you have sold off the asset, then what are you going to do with that? You have to cancel that. So how do you cancel? In accounting, see, you created this contra asset account, this accumulated depreciation or provision, by crediting it. It was increasing over here. Now you will be making an equal debit. Okay, equal debit. I mean, by equal I mean 3,000 was there now. So equal to 3,000. Here also you will debit by 3,000 and cancel off the depreciation you have charged up till now on that asset. Is that clear? That is what you will be doing. And you will, take that to asset account. So asset account will be reducing. Now what's happening? Why asset account is getting credited? You'll be a little bit confused. Understand. When you were charging the depreciation over here, you are not touching the asset account. Yeah. If we are not touching the asset account, then asset was existing. Yeah. On the date of sale, asset was existing at original cost. It was at original cost. Yeah. So when you credit the asset account, when you take the accumulated depreciation to asset account, what will happen? Asset account will come to its WDV. Asset account will come to its WDV, to its book value, actual book value, okay, from original cost. Okay, so we'll see that practically when we'll solve the problem. Okay, don't worry. But that's the logic. Here you are eliminating both the things. You are eliminating accumulated depreciation by debiting it because it has credit balance. To eliminate it, you have to debit that accumulated depreciation, debit. Okay, and then asset account has debit balance. To cancel that, you have to credit, because asset account always used to exist at original cost, because this is provision for depreciation case. You are maintaining provision for depreciation or accumulated depreciation. So asset is existing at original cost. So to bring it to WDV, you have to credit it. By which amount? By accumulated depreciation amount. Okay, that is what you have to do. Is that clear? Right. After doing this, asset has come to WDV, and then what you have to do? You have to pass this actual sale of asset entry, disposal entry. What's happening over here? The same entry. You are getting the money, bank account debit. You have sold off the asset now. Just record that transaction. Bank account debit. You have received, let's just say 1 lakh. Okay, 1 lakh sale value. Yeah, that's what you have to take. And then you will take the asset value to asset account. Yeah, the one which you have sold. And then you have to compare the sale value and the asset value, and whatever difference is there, either that will be profit or loss. If sale value is more, it's profit. If sale value is less, it's loss. Either it will be loss on disposal or profit on disposal. Okay. If the gap is there in the debit, then that will be loss on disposal. Okay. Here in the debit. If the gap is there in the credit, that will be profit on disposal. Is that clear? Simple and straightforward. Now let's just move on to the ledger accounts. Now see the ledger accounts over here. Asset account. Asset account has debit balance. You all know, opening balance on the debit side, closing balance on the credit side. And you all know here we are maintaining what? Provision for depreciation or accumulated depreciation. So the asset value will be always at original cost. Okay, fine. And if you have purchased any asset, then it will come over here to bank at cost. That's what happens, right? Simple. And then see here, what else? Yeah, accumulated depreciation. Now in accumulated depreciation, understand here what's happening. Think about the procedure of sale. When you sell the property, plant and equipment, three things you have to do. I have always told you. The first is you have to charge the depreciation. The first thing, when you sell off the asset, you have to charge the depreciation. So when you charge the depreciation, you will not be charging it in the asset account. You all know here we are maintaining provision or accumulated depreciation. So you'll be charging the depreciation over here. Accumulated depreciation account, accumulated depreciation account credit because of depreciation. This is increasing because of depreciation, isn't it? See, depreciation account debit to accumulated depreciation. Okay, so you'll be charging a depreciation over here. Fine. And there will also be balances over here in accumulated depreciation. Always there will be balance. By balance B by D, to balance C by D. Fine. Okay, so you will charge a depreciation on the asset which you have sold, and then at the year end also you will charge a depreciation over here only by depreciation. Okay, one more depreciation will come over here, and then this entry will be passed. Accumulated depreciation account to asset account. So in this entry, what's happening? Accumulated depreciation account is getting debited. Accumulated depreciation account is getting debited because of asset. Okay, this entry. So immediately cross posting will happen over here. Asset will be reduced from original cost. It is getting reduced by accumulated depreciation amount of that asset which you have sold. So that asset will come at its WDV, at its book value. Okay, is that clear? You understood this? Simple. And then you have sold off the asset now. So asset is decreasing because you have sold it off by bank and you have got the money, and the sale value will come over here, whatever money you have received. Clear? Simple. And then you have to see the balancing figure, and the balancing figure, you have to do the calculation actually. Okay, this comparison you have to do. Okay, this calculation properly you have to do, and you have to find out whether there is loss on disposal or profit on disposal. If there is profit on disposal, then it will come on the debit side. If there is a loss on disposal, it will come on the credit side. Is that clear? Because understand, it's really simple to understand. Think about the profit and loss account. In profit and loss account, on the debit side all the expenses comes, on the credit side you have all the incomes. So to facilitate the cross posting, the profit will come over here on the debit side. In the profit and loss, this will go on the credit side. Okay, the loss will come on the credit side, but in profit and loss, this loss is an expense now, it has to go on to the debit side. Is that clear? That's the logic. And the closing balance. Okay, right. So this will be very simple once we solve the problem. Okay, here it's just a format basis, just to give you an overview. So accumulated depreciation also you understood. Opening balance, closing balance. Okay, opening balance on the credit side, closing balance on the debit side, because this accumulated depreciation account has credit balance. Fine, right? And you also know that the amount will be taken over here, right? Whatever depreciation you have charged on the asset which you have sold, that much depreciation you have to take to the asset account. Accumulated depreciation account decrease, it is getting eliminated because of the asset which you have sold. Fine, easy. And then depreciation account is nothing, it's just cross posting. See here, by depreciation will be there in the accumulated depreciation. So cross posting you will do to accumulated depreciation, and that amount will flow into profit and loss account. Simple and straightforward. Okay, so what did we do over here? We did not open asset disposal account. So what did we do then? If we are not opening asset disposal account, then we are making use of the asset account only. All the sales transaction is happening in the asset account only, isn't it? Accumulated depreciation is flowing over here, right? The money which you are receiving is also coming over here. Okay, and then profit or loss also in the asset account. So this is what do we do when we are not maintaining asset disposal. What happens? The asset account looks very messy. Okay, it looks very messy because everything has been taken into asset account, right? All the disposal transactions. Simple, easy. Now let's just see a problem on this, and then we'll move on to the case 4. Now see, here we have our 6th problem, and here we are selling our tangible fixed asset. We call that as disposal of PPE, and here we have case 3 accounting treatment. Case 3 accounting treatment means we are maintaining provision for depreciation or accumulated depreciation account, but when we are selling off the asset, we are not opening asset disposal account. Okay, fine. So let's go through the question first. The following balances exist in the books of Hari Limited as on 1st April 2021. Okay, machinery account 8 lakhs, accumulated depreciation account or provision for depreciation account 3,10,000. Okay, So you see in this question what's happening, already there are balances. So these are opening balances on 1st April. These are opening balances, machinery 8 lakh and accumulated depreciation 3,10,000. Fine, you understand that. On 1st July 2021, 1st July means just after 3 months, isn't it? April, May, June, right? Just after 3 months, 1st July now, so you will not count July. So on 1st July, just after 3 months, a machinery which was purchased on 1st April 2018 for 1,20,000 was sold for 50,000. So you understand? A machinery which you had purchased on 1st April 2018 for how much? For 1,20,000. This is the original cost. 1,20,000 was sold. Yeah, on this 1st July, it was sold for 50,000. And on the same date, another machinery was purchased for 32,000. Okay, fine. The firm charges depreciation at 15% per annum on cost. On cost means here we have SLM method, straight line method, and closes its books on 31st March every year. Okay, that's the ending date, 31st March. Prepare machinery account and accumulated depreciation account for the year 2021-2022. So in this question, you can see the requirement. They are asking for machinery account and provision for depreciation account. They are not asking for asset disposal account. So we have to solve this problem from case 3 accounting treatment without asset disposal, but we are maintaining provision for depreciation. Is that clear? Simple and straightforward. Okay, and they are not asking depreciation account, so you don't need to create that. But if they do that, you may have to create that also, but that's simple, just cross posting and transfer to profit and loss. You all know that. So first let's just draw up the timeline. See here the timeline. 1st April 2021, we had the balances, machinery and accumulated depreciation account 8 lakh, 3 lakh, 10,000, and then just after 3 months on 1st July 2021, we sold machinery for 50,000. Now when we sold the machinery, they also gave us some other information, that was, you know, when we had purchased it, yeah, the purchase date, and then the original cost also, because we can charge the depreciation properly. Okay, that is why we need that information, right? And then on the same date, we have purchased another machine. Okay, another machine has been purchased for 32,000. So here understand properly. First we have to do this disposal properly, disposal of this machine which we have sold for 50,000, and then we have purchased another machine now. So this another machine also we have to calculate the depreciation. Okay, first let's just calculate the depreciation on that another machine. Okay, see, it's really simple. You have purchased the machine in between the year. So whenever you purchase a machine in between the year, what you have to do? You have to charge proportionate depreciation, right? And this is purchase now. So from date of purchase till year end, that's the shortcut you follow. So from July till 31st March 2022. So see here, July, August, September, October, November, December, January, February, March. So it's 9 months from 1st July till 31st March 2022. So 9 months depreciation needs to be charged on this 32,000 new machine. So let's just calculate this directly. 32,000 into how many percent? What's the percent? Percentage is 15%, right? And straight line. So directly on the cost we apply. So into 0.15, that's equal to 4,800. But can we take this directly? Of course not. We have to proportionate. 9 months, only 9 months. We had this asset only for 9 months, this new machine. Okay, so into 9 divided by 12, that's equal to 3,600. So 3,600 is the depreciation on this second machine which we have purchased. Is that clear? So that simple thing we have easily tackled it off, right? Now let's come to the disposal, the main point of this question. Okay, so what we have to do over here is we can do a simple working note over here to calculate that. Okay, what will be the depreciation we'll be charging over here, what is the profit or loss we have made on this disposal, all these things we have to calculate. Now first recall the procedure. What is the procedure? 3 things are there, right? The first is you have to charge the depreciation on the asset which you have sold. Let's do that. Okay, so see, what was the original cost of the machine which we have sold? Original cost was 1,20,000. So see, calculation of profit and loss on disposal. Original cost of that machine was 1,20,000 as given in the question. Yes, right. Now let's calculate the depreciation. How much depreciation you have to charge in the current year? In the current year, you can easily understand. See, from the beginning of the year till the date of sale. That is the shortcut now. When you sell the machinery in between the year, what is the shortcut? The shortcut is beginning of the year till the date of sale. That shortcut you have to follow and calculate the depreciation. So see, 1,20,000 is the original cost into 0.15. It's SLM now, on original cost only will calculate. Okay, into what? The months. How many months? From 1st April till 1st July is 3 months. So 3 divided by 12, that's equal to 4,500. So 4,500 is the depreciation you will be charging in the current year on this asset. On which asset? The asset which you have just sold. But understand, you don't have WDV value of this asset. You don't have book value of this asset. You have the original cost. So from original cost, from 2018, you have to come to 1st July. From 2018, you have to come to 1st July 2021. So to do that, what you have to do, understand properly, you have to subtract the depreciation of previous years also, isn't it? From 1st April till 1st July. So let's just come to 1st April 2021 first. Okay, see, 1st April 2019, okay, 1st April 2020, 1st April 2021. Okay, so 3 years depreciation you have to calculate and deduct from 1,20,000, and then only you will deduct the current year depreciation. Okay, that is the thing you have to do. So in total, what do we call this? The combination of depreciation. What do we call that? We call that as provision for depreciation or accumulated depreciation, isn't it? So that is what you will have to subtract, minus accumulated depreciation up to 1st July 2021. So let's calculate the depreciation. It's SLM now. So same depreciation is there in every year. So just calculate one annual depreciation. It's enough. Okay, just 1 year depreciation is enough. So the cost was 1,20,000 into 0.15. So that's equal to 18,000. So 18,000 depreciation in 2019, 2020, and 2021. Okay, year ended 2019, year ended 2020, year ended 2021. Okay, so 3 years depreciation and then current year depreciation of 4,500. You understand this calculation? Simple and straightforward. Okay, you understand this? 18,000 annual depreciation. Okay, so from 2018 we are coming to this date, 1st July. So the depreciation of 3 years, that's 18,000 into 3, that's equal to 54,000, plus the current year depreciation of 3 months, 4,500, that's equal to 58,500. So this 58,500 you have to subtract, and when you do that, what do you get? You get WDV 61,500. Okay, 58,500 minus 1,20,000, that's equal to 61,500. Ignore the negative. Okay, right, 61,500 is the WDV. This is WDV. From WDV you have to subtract the sales proceed, isn't it? You all know what do we do? First you have to charge the proportionate depreciation on the asset which you have sold, and then calculate the WDV on the date of sale, right? And then you have to compare the sale value with WDV and find out whether there is profit or loss. Okay, so we have found out the WDV. It's 61,500. Compare it with sales proceed. You have sold it for 50,000. So minus 50,000. We are comparing it now. So we can see that WDV is more than sales proceed. So of course you can understand. Yeah, this much money you have got and the WDV is this much. So of course you have made a loss, right? WDV is more, book value is more. You have made a loss. Loss of how much? 11,500. Okay, 61,500 minus 50,000, that's equal to 11,500. That's the loss on disposal. And then what? And then you also have to calculate the depreciation on this 32,000. Now we already did that in calculator. It was 3,000 something. Yeah, new machinery, 32,000 into 15% into 9 by 12. Okay, only this period from date of purchase till the year end. Okay, 9 by 12, 3,600. And understand on the remaining machinery also you have to calculate the depreciation now, isn't it? See, machinery balance was of 8 lakh. Out of this original cost, this is original cost now. Out of this original cost, only 1,20,000 you have sold. The machinery of original cost 1,20,000 you have sold for 50,000. Remaining is there now. Remaining 6,80,000. 8 lakh minus 1,20,000, right? 8 lakh minus 1,20,000. So remaining 6,80,000 original cost of machinery is there. On this also you have to charge the depreciation now. This was there for the entire year. So for entire year you have to charge the depreciation on that. So 6,80,000 into 0.15, that's equal to how much? 1,02,000, right? 1,02,000. So 1,02,000 will be the depreciation on the remaining machinery. Fine. Now let's see the ledger accounts. Now see, here we have the ledger account. Let's understand. It's really simple. You have already prepared the working notes, so all the calculation is completely finished. Nothing is there. You just have to fill in everything and use the basic accounting knowledge, debits and credits. Okay, fine. So see, machinery account has debit balance, so opening balance will be on the debit side. Is there any opening balance? Of course there is. In the question they have told us machinery account has 8 lakh opening balance, so it will come on the debit side. You all know, to balance brought down 8 lakh. Simple, easy. And then in this current year you have purchased a new machinery also, yeah, of 32,000, isn't it? So just record that machinery is increasing, machinery account debit because of the bank, the money which you have paid through the bank. Yeah, you have purchased a machine, to bank account 32,000. Simple, easy. And then what happened? And then we have sold the machinery for 50,000, isn't it? So just record that machinery is decreasing, we have sold it off, so machinery is of course decreasing, it's getting credited because of bank, the money which we have received by selling off the asset. This happened on July 1st by bank, 50,000. Simple, easy. Now on the same date you also have to do the remaining procedures also, isn't it? What are those procedures? You have to calculate the depreciation. Yeah, we have done that, right? How much of the depreciation? Current year depreciation 4,500. So just do that. See here, provision for depreciation, or you can call this as accumulated depreciation account. So accumulated depreciation account is getting credited because of the depreciation. But before this, of course, you will be opening the balance over here, by balance B by D, 3,10,000 as given in the question. Accumulated depreciation 3,10,000. Okay, so after writing the opening balance, then you have to do that depreciation thing, and this is happening on July 1st. Okay, July 1st by depreciation account 4,500. Yeah, on sold machine for 3 months. Okay, simple, easy. So then what you have to do, you have to take whatever accumulated depreciation is there of that asset to over here, where? To the asset account. So how will you do that? It's really simple. See, we have already calculated that over here, 18,000 plus 18,000 plus 18,000 plus 4,500. Yeah, this is the entire accumulated depreciation, 58,500 from 1st April 2018. How much depreciation you have charged till now, till 1st July, that much depreciation you have to remove from this account. That much depreciation you have to remove from this account and take it to the asset account. This is the logic. Okay, this is what is happening in that entry which I talked about earlier. See, in this entry, accumulated depreciation account debit to asset account. What's happening over here? How much depreciation you have charged up till now, up to the date of sale, that much depreciation you have to remove from accumulated depreciation, and you have to take that to asset account, and asset account is getting reduced. So let's see how it's happening over here. How much is that amount? 58,500 accumulated depreciation. So here you see, provision for depreciation or accumulated depreciation account is getting debited, it is decreasing, it's getting eliminated because of the machinery which you have sold. What's the amount? The amount is 58,500. The depreciation charge till the date of sale, yeah, from the date of purchase till the date of sale, from when you started the charging depreciation till the date of sale. Is that clear? That is what you have to do. So now the cross posting of this will go over here, by provision for depreciation or by accumulated depreciation, 58,500. So asset account got reduced because of that. Is that clear? Asset account is getting reduced because of that, now, isn't it? Yes. And then what you will be doing, and then you have to calculate the profit or loss on sale of machinery in the working note now. So we have already done that. That is 11,500. So you have to record that. You all know the loss on sale of machinery, the loss on disposal will come on the credit side. Okay, by loss on disposal, that is 11,500. Clear? So all the calculation will be done beforehand itself in the working note. You just have to fill over here. Is that clear? Simple. So this is the entire year only. This is 1 year only. It started on 1st April. Now it's ending at March 31st. Okay, right. So now what you have to do, on March 31st, you have to take the closing balance, which is the balancing figure, 7,12,000. Let's just calculate this. See, 8 lakh plus 32, that's 8,32,000. Write that on both the sides. Yeah, write that on both the sides. So 8,32,000 minus 50,000 minus 58,500 minus 11,500 that's equal to 7,12,000. That's the closing balance in the machinery account. Okay, fine. And then here also you have to balance this out, but before that you have to charge the depreciation on the remaining of the asset. What is that remaining of the asset? This remaining machinery from that 8 lakh, 6,80,000 was remaining. On that you charge 15%. Yeah. Now why did you calculate 15% on this 6,80,000? Because 6,80,000 is original cost, and in this question we have straight line method. In straight line method we can calculate, depreciation on original cost only. So that is why we directly could calculate on the original cost. Fine. So 1,02,000 plus 3,600 on the new machinery, 32,000. So in total that is 1,05,600. So this depreciation you will be charging over here. Provision for depreciation is increasing because of depreciation. Yeah, this entry. Which entry is that? This simple depreciation entry, depreciation account debit to accumulated depreciation. Accumulated depreciation or provision is getting credited. It's getting credited because of depreciation. Clear? Simple and straightforward. Fine. And then you will find out the balancing figure. And the balancing figure means the closing balance over here, right? So 3,10,000 plus 4,500 plus 1,05,600. See, 3,10,000 plus 4,500 plus 1,05,600. That's equal to 4,20,100. Write that on both the sides, and then subtract this 58,500 which you eliminated from over here. So once you subtract that, that's equal to 3,61,600. This is the closing balance of provision of accumulated depreciation. Clear? Easy. So this is how you will be doing this. So what happened over here? Take the conclusion properly. Here what did you do? You charge the depreciation over here only, because you are maintaining this provision by depreciation. Yeah, opening balance you got from the question, and then you found out in the working note how much depreciation have been charged up till now, up to the date of sale, on the asset which I have disposed, on the asset which I have sold. So that much amount I reduced from provision for depreciation, and I took that to the asset account. And then whatever balancing figure was there, that was the closing balance, 3,61,600. This is what happened in this account. In this account, what happened? Opening balance I took. Okay, any machine did I purchase? Yes, we had purchased. So yeah, it came over here to bank account, right? And then the disposal entries, the disposal postings we had to do, we have sold, so machinery is decreasing because of the money which we have received by selling of the asset by bank, 50,000. And then the cross posting which came over here, right, by provision for depreciation or by accumulated depreciation, 58,500, right? And then we had already calculated profit or loss, so it was loss actually, so loss will come over here. You recorded that, and then you balance this account. This was bigger, right there on both the side, minus this, you got the closing balance as 7,12,000. Simple and straightforward. So you have understood this properly. Okay, right? So case 3 is over. Let's move on to case 4. Now see, here we have case 4 accounting treatment of disposal of PPE. That is when we are maintaining provision for depreciation account or accumulated depreciation account, and we are also opening a temporary account called as asset disposal account when we sell off the asset. And whatever transaction or the event that will be taking place because of disposal, those will be recorded through this account only, asset disposal. Is that clear? Yes, you already know what is asset disposal account, isn't it? I have already explained this in the previous video. It's just a trash can, it's just a waste bin, right? Whenever you want to throw something out, you don't directly throw it outside your home. No, what do? You will have a trash can in your home. You will put first in the trash can, and then the next day when the garbage truck comes, you will take out the trash, isn't it? And the garbage truck will take it away. Here also same, when you want to sell off any asset, what will you do from the accounting perspective? You will take it into the asset disposal account, and then from the asset disposal account you will sell it off. So all the transaction, whatever is there, the money which you have received, that posting will be happening in asset disposal. Okay, and then the accumulated depreciation account also will be taken over here. Okay, the balance of the asset which you have just sold, so that balance will also go into this account, and then the profit or loss which you will make, that will also be reflected in the asset disposal account only. Okay, so let's begin. Let's understand the journal entries now. Here first we have purchase journal entry. which is exactly same, no difference at all. Asset account debit to bank account. And then we have depreciation journal entry. That's also exactly same. When we maintain the provision, we credit accumulated depreciation or provision for depreciation, isn't it? And this entry will be passing twice. You all know, one at the date of disposal when you sell off the asset. Yeah, that's when you charge the depreciation on it. And the second is when you are at the year end, you will be charging the depreciation on remaining of the asset, isn't it? So 2 times you will be passing this entry. Yes, you know that. And then at the year end, you have to close the depreciation account by taking it to profit and loss. How that will happen? Profit and loss account debit to depreciation account, isn't it? Yes. Fine. And then we have the main journal entries, that is the disposal journal entries. Now in disposal journal entries, what's happening? In disposal journal entries, understand this properly. First, what will you do is, first you will take the asset at its original cost to asset disposal. What did I say? You will take the asset at its original cost to asset disposal account. Yeah, asset used to exist at its original cost only, because we were maintaining accumulated depreciation account now, or provision for depreciation. So asset is at its original cost only. So when asset will go into asset disposal, it will go at original cost. So asset disposal account debit to asset account. This is the journal entry. Now you will wonder, what's the logic of this entry? It's really simple. Understand. You are reducing the asset. Asset has debit balance. If you are reducing the asset, then what should happen from the accounting perspective? Whether you will debit or credit it. Asset has debit balance, so you will credit it to asset account. Yeah, asset value is reducing and it's going to asset disposal. Okay, so you will credit the asset account. Once you understand the logic of this, you will credit the asset account. Then understand, entry cannot be handicapped. Yeah, there should be a debit, and that debit should be asset disposal account. Is it clear? This is the logic. Fine. So asset disposal account came into existence with a debit. It didn't used to exist before. Today, let's just say you have sold one asset of 1 lakh. Okay, the original cost of the asset was 1 lakh, let's just say, for example. Okay, so now what you have to do, you have to reduce 1 lakh from the asset account, and you have to take this into asset disposal account. So how will you do this from accounting? You have to credit the asset and debit the asset disposal. Okay, credit the asset and debit the asset disposal. So asset disposal came into existence today with a debit. So this account will have a debit balance. Okay, right, and this will be at its original cost. Okay, so 1 lakh is at original cost. Let's say, for example, 3 years has been passed since we have purchased this asset. We have charged 3 years of depreciation on this. Okay, let's just say 10,000 every year, straight line method. So how much depreciation have we charged? 30,000, isn't it? 10,000, 10,000, 10,000, 30,000 depreciation we have charged. But in the asset account, it is at its original cost only. So when it went to asset disposal, it went at its original cost, because we are maintaining provision now. When we maintain the provision, asset will stay at original cost. You all know that, right? Yes. So what we have to do is, in the very next entry, we have to transfer accumulated depreciation to asset disposal. Okay, now how it will happen? What's the logic? Yes, we understood. First, we took the asset to asset disposal. Then you are saying that we have to take accumulated depreciation on the asset which we have sold. Yeah, that balance to also to asset disposal. So how that will happen? Understand, it's really simple. Which balance does accumulated depreciation account has? It has credit balance, isn't it? Accumulated depreciation or provision for depreciation has credit balance. So you want to eliminate that, you want to kill that. So how will you kill? How will you eliminate? If it has credit balance, you have to debit that. So accumulated depreciation account debit. Okay, so if this is getting debited, if this is getting eliminated, then there should be an equal credit. And we know that we are taking this to asset disposal. So you will credit the asset disposal account. Okay, so accumulated depreciation account debit to asset disposal. This is the entry, right? So now what is happening mathematically behind this accounting picture? 1 lakh you have taken to asset disposal. So asset disposal increased by 1 lakh, and then what happened? You have credited the asset disposal by how much? By 30,000. For example, you are taking 30,000 of depreciation, accumulated depreciation of 3 years into asset disposal. So minus 30,000 it will be. Okay, minus 30,000. So what will happen then? Behind this accounting picture, the asset disposal will be at its WDV 70,000. Okay, book value at its carrying value. Is that clear? Do you understand this? First, you took the asset of 1 lakh in the asset disposal. Okay, asset disposal increased, and then accumulated depreciation was also taken, but accumulated depreciation over here is negative. Okay, so minus 30, so it becomes 70,000. Now this is the WDV of the asset in the asset disposal account, isn't it? Yes. So now this 70,000 you have to compare with the money, whatever money you will receive by selling of the asset. Let's just see that following entry. See, bank account debit to asset disposal account. You see, all the transaction of disposal are happening, all these events are happening in the asset disposal account only. Bank account debit, you have received the money. Okay, so here what you will be taking, you all know, here you will be taking the sale value, right? Sale value. Bank account debit, you have received the money, and then you have to take it in the asset disposal to asset disposal account. Okay, is it clear? See, bank account, money is coming in, it's increased, you have debited that, and asset disposal is no more, isn't it? You have sold off the asset now, so you have to close the asset disposal also. Asset disposal you have to decrease. So how will you decrease? First, it came into existence by a debit, so it has debit balance. Now you have to kill it off, you have to finish off the asset disposal because you have sold, so asset disposal needs to be credited. Okay, credited, fine. So that is what you will do, and the difference between the WDV and the the sale value will be either profit or loss on disposal. Okay, if there is a gap in the debit, then that's loss on disposal. Yeah, in the journal entry, I mean, in the ledger account it's a bit different, and in the credit it's profit on disposal. Fine. Now let's see the ledger accounts. Now see the ledger account, the first is the asset account. Here we are maintaining provision now, so asset account, you all know, will be at its original cost, isn't it? Yes. So asset account has debit balance, opening balance on the debit side, closing balance on the credit side, and if you have purchased any new asset, then asset account is getting debited because of bank and the cost you will take, right? Yes. And then here you are not charging depreciation, nothing is happening. Okay, nothing is happening of disposal in this account. It's just that whatever asset you have sold, just take that asset, just take the original cost of that asset into asset disposal. That's all you have to do in the asset account, right? So let's just say, for example, we have sold one asset, the same example of 1 lakh, original cost 1 lakh. So what we'll be doing, asset account is decreasing by 1 lakh, okay, by asset disposal. Is it clear? So asset is being reduced because of asset disposal. Which journal entry is this? This one. Asset disposal account debit to asset. So asset is getting credited now. Asset is getting credited because of asset disposal. Is it clear? So the cross posting of that will happen in asset disposal. In asset disposal, this account will come into existence plus minus. Okay. So this account will come into existence. Asset disposal is increasing because of the asset. The cross posting. Okay. The cross posting. Do you understand? Easy. Next you will find out the closing balance. That will be by balance C by D. Okay, so asset account is completely over. Now come to the accumulated depreciation account. Accumulated depreciation has credit balance, you all know, right? Credit means plus, debit means minus, opening balance on the credit side, closing balance on the debit side. Yeah, yes. And then what you have to do in accumulated depreciation, what do you do over here always? When you maintain provision for depreciation or accumulated depreciation, what you do is you charge the depreciation in this account. Isn't it? This entry, depreciation account debit to accumulated depreciation. I told you minimum you will be passing this entry twice. One at the date of disposal, you have to charge the depreciation on the asset which you have sold, and at the year end on remaining of the assets, right? So that is why here two depreciation will be coming. Accumulated depreciation account is increasing because of depreciation, one on the date of disposal and the other one at the year end. Clear? Simple. So this is what you will do. And then whatever accumulated depreciation is there of the asset which you have sold, that you have to take to asset disposal. Accumulated depreciation is decreasing. By which amount? By the amount of accumulated depreciation on the asset which you have sold. Okay. So I told you now, let's just say for example, you had an asset since 3 years. So 10,000, 10,000, 10,000, 30,000 depreciation has been there. It has been accumulated in this account. Yeah, it has been carry forwarding, right, in this account. So now that 30,000 you have to take to asset disposal. How that will be happening? Accumulated depreciation account is getting decreased because of asset disposal, 30,000. Do you understand? In asset disposal, that 30,000 accumulated depreciation is going. Okay, so see the cross posting over here. Asset disposal is getting decreased because of accumulated depreciation. Here accumulated depreciation got decreased because of asset disposal. Here also the cross posting will come. Asset disposal is getting decreased because of accumulated depreciation. Okay, so these two things, 1 lakh and 30,000, will offset each other, and behind the picture the asset disposal is, kind of at the WDV, at the book value. Is that clear? Simple. Fine. And then you will, balance the accumulated depreciation account. There will be some opening balance, the depreciation which you have charged in the current year, and this, you have to consider all this. Just add it up, write it on both the side, minus this, you will get the closing balance. Accumulated depreciation account is over. Come to the asset disposal account. Here you already have this 1 lakh over here and 30,000, for example, right? So now what you have to do, you have to, you will already be doing this calculation in the working note, how much profit you have made and everything, right? So here you just have to fill the data. Okay, no calculation directly over here. So here what will happen, you have sold off the asset now, so asset disposal account needs to be closed. If you have sold off the asset disposal needs to be closed. So asset disposal is decreasing because of the money which you have received by selling off the asset by bank sale value. Is it clear? Here asset will come at original cost. Here you have taken the depreciation till the date of sale, which is called as accumulated depreciation, and then here you are taking the sale value of the asset for how much you have sold by bank. Is it clear? Asset disposal is decreasing because of bank. Fine. Yes. And then you will be already knowing through the working note calculation what's the profit or loss. Then you will directly take over here, either it's profit or loss. Clear? If it's profit on the debit side, if it's loss, it's on the credit side. Okay, so asset disposal account is completely over. There will not be any balance, any closing balance or something in asset disposal, because this is just a temporary account. This is just a dustbin, just a trash can. You took the asset over here and then you saw how much depreciation is there. So you took the depreciation over there and then how much money you have received, right? And then either profit or loss, this account will be tallied and it will be completely finished. Is it clear? Asset disposal is really simple and straightforward. And then we have depreciation account, which is really simple. You will just see in the accumulated depreciation account. Here you have by depreciation 2 times, one on the date of disposal and the second one on the year end. So you will just do cross posting over here, 2 accumulated depreciation, 2 accumulated depreciation. Okay, both the depreciation you will be taking, and then that will flow into profit and loss. You know that you will close the depreciation account. Really simple and straightforward. All right. So that's what you have to do. So you have completely understood the format of case 4. Now let's just go and solve one problem on this from the study material if we can. Okay, let's just now see here we have our 7th problem, and this question is actually illustration 8 from the CA Foundation study material. Okay, right. So now here we have the question. Let's read this. On 1st April 2018, Shubhra Limited purchased a machinery for 12 lakh. Okay, 1st April 2018, machine 1 was purchased by Shubhra Limited for 12 lakh. Okay. On October 1st, 2020, a part of the machinery purchased on April 2018, a part of the machinery purchased on April 2018, 1st April 2018, for 80,000. The cost of that part is 80,000, was sold for 45,000. Was sold for 45,000. So a part of 80,000 has been sold on 1st October 2020 for 45,000. So you have to properly plot this on this timeline. So how will you do that? First, you have to know when is the year end. You can see here, show the necessary ledger account for the years ended on 31st March 2019, right, to 2021. So the the year ends on 31st March. So 1st April 2018, the year will end on 31st March 2019. You all know this, right? So this is the year end, and this happened on 1st October 2020, the sale. So not in this year. See in the next year. In the next year also it's not happening. 31st March 2020, 1 year passed, 2 year has been passed, and then it's happening in this year after 2 years. In the 3rd year it's happening. Yeah, see, 31st March 2020, now this is the year end, and then from 31st March till 1st October, how many months? 6 months, isn't it? April, May, June, July, August, September, not October, only 6 months. Yeah, because it's 1st October, you will not consider the October month. So on 1st October 2020, what you have done, this Shubhra Limited have sold a part of the machinery which was purchased on this date for 80,000. The cost, the original cost was 80,000, has been sold for 45,000. It has been sold for 45,000. M1 part has been sold for 45,000. Clear? Simple. And then they are saying, and a new machinery at a cost of 1,58,000 was purchased and installed on the same date. On the same date, we have purchased, this Shubhra Limited has purchased another machinery for 1,58,000. Is it clear? Fine. The company has adopted the method of providing 10% per annum depreciation on the written down value of the machinery. With this sentence we can understand 10% is the rate of depreciation and the method is WDV method, reducing balance or diminishing balance method. Okay, written down value method. Fine. Show the necessary ledger account for the year ended 31st March 2019, okay, to 2021. Assuming that provision for depreciation account is not maintained, okay, we will not solve the case 1, we will only see the case B, when provision for depreciation account is maintained. And the study material has solved this from case 4, this B case. Okay, this B question now, provision for depreciation account is maintained. This, the study material has solved it through the case 4. You can also solve it through case 3, but it's better for case 4. Okay, I told you case 4 is the most practical one, right? So let's begin. Now first what you have to do is you have to prepare a working note. Okay, see the working note properly. Let's just see this working note you have to prepare for the calculation of depreciation, WDV and the profit and loss, everything. Okay, so I have just copied the timeline over here just to make it easier, and we know the method is WDV and the rate is 10%, right? So first what you do, you will break this M1 into 2 parts. Yeah, the first is that 80,000 part which you have sold after 2 years and 6 months, and the remaining part. Okay, so see, M1 11 lakh 20 and M1 part is 80,000. How is this? It's really simple. See, 12 lakh was the total machinery, right? Total machinery minus 80,000, the part of the machinery which you have sold, so 11 lakh 20. So you understand, I have bifurcated the machinery's value. Is it clear? M1 and M1 part, 11 lakh 20 and 80,000. Clear? Easy. We'll come to the M2 later onwards. Okay, right. So now first what you have to do, first you have to calculate how much depreciation you will be charging in this year on 31st March 2019. So we know it's 10%, so simple. See, 11 lakh 20,000, just take 10% of that, that will be 1 lakh 12,000. I don't need to calculate, it's just 10%. Just remove the 0, you will get the answer, right? So 1 lakh 12,000, and then here also 10%, that's 8,000. You have to charge the entire year depreciation because the purchase has happened on the first day of the year. So entire depreciation you will charge, entire 12 months depreciation. Is it clear? Right. So after that you will subtract and you will get WDV over here, right? This is WDV. WDV on 31st March 2019, 10 lakh 8,000 and 72,000. 80,000 minus 8,000, 11 lakh 20 minus 1 lakh 12,000. Clear? Simple. And then what will happen? In this year also nothing happened, so you have to charge the entire year's depreciation, same like before, but this is WDV method, not straight line method. You cannot directly calculate on 11 lakh 20. No, you have to calculate on 10 lakh 8,000. You know now. So 10% of 10 lakh 8,000 will be 1 lakh 800. Just remove the 0. You will get the answer, right? It's just 10%. So minus depreciation for 2020, year ended 2020, that's 1 lakh 800. And here it is 7,200. You can easily, get to know that, right? Now 10 lakh 8,000. Let's calculate this. 10 lakh 8,000 minus 1 lakh 800, that's equal to 9 lakh 7,200, right? And this also you subtract 72,000 minus 7,200, that's equal to 64,800, isn't it? Yes. So here you have reached, where you have reached, this is the WDV at the year ended 2020. So you have reached over here. Now from here you have to go on 1st October 2020 regarding the M1 part, For the remaining this 11 lakh 20, you will charge the entire year depreciation, isn't it? Understand the logic. M1 part you have sold, M1 you have not sold. M1 is still there, 11 lakh 20. So what you have to do, you have to charge entire year depreciation on this. Let's just do that. See, 9 lakh 7,200 into 0.10, that's equal to 90,720. What did I do over here? I charged entire year's depreciation on the M1, okay, that's what I did. And then just subtract this with that 9 lakh 7,200, that's equal to 8 lakh 16,480. So this is the WDV, on 31st March 2021 of the M1, okay. But the M1 part has been sold in between the year. If it is sold in between the year, what do? It's an exception now. We cannot charge 12 months depreciation. We have to proportionate. You all know this. So how will we do that? It's really simple. See, the WDV is 64,800. So on 64,800 you have to charge 10% depreciation. So that's equal to how much? that's equal to 6480. But can we take this? No, we have to proportion it because it has been sold in between the year. So from March till 1st October, it is 6 months. So you have to proportion it into 6 by 12. That's equal to 3240. So 3240 will be the depreciation on M1 part of M1. Okay, see here 3240. Okay, this is the depreciation for year ended 2021. For this entire year depreciation, for this proportionate depreciation. Okay, so 3240 minus 64,800, the previous WDV, that gives us 61,560, 61,560. This is the WDV on the date of sale. Understand, this is all these three are WDV only. What the hell? What's happening? I think battery is low. Yeah, battery is low. Seems, yeah. So see, 61,560. Okay, that's the WDV on the date of sale. Is it clear? I told you now, 3 procedures you have to follow. What are those? The first one is you have to charge the depreciation from beginning of the year to the date of sale on the asset which you have sold, right? So we had to charge 6 month depreciation and then deduct that from the previous WDV. You will get the WDV on the date of sale, and then this you have to compare with the sale value, whether it is more or less. If it's more, if the sales value is more than WDV, then we have got profit. If sales value is less than WDV, then we have got loss, isn't it? So this comparison we have to do over in this working note only, over here only in this working note. So how it will happen? Really simple. See, 61,560 is what? This is the WDV on the date of sale. So just compare this with the sale proceeds. Sale proceeds are 45,000. See here in the timeline, M1 part has been sold for 45,000, isn't it? Let me just show you the question. Where was that? Yeah, 80,000 was sold for 45,000, right? So 45,000 is the sale proceeds. So just subtract that, 61,560 minus 45,000, 61,560 minus 45,000 sale proceed. So 16,560 is loss. You can easily understand now. 61,560 was the book value and sale proceeds are just 45,000. So of course you have made a loss, and the loss is of 16,560. So it's better to do this working note and then you can directly fill everything. Okay, now let's see the M2. In the M2 what happened? You understood all this, yeah? All these are over. M2, in M2, see, M2 we purchased for 1,58,000, right? Here I have written the cost now, so that is why I have taken this in the beginning. I cannot take this over here somewhere because it will be WDV or something else. So that is why it's taken in the beginning. Cost 1,58,000. On this 1,58,000 you have to charge the depreciation, isn't it? So in 2019, 2020 you didn't have this M2, right? M2 you purchased in this year only, in the current year only, on 1st October 2020. So what's the shortcut when you purchase the asset? From date of purchase till the year end. That's how you charge the depreciation. From date of purchase till year end. That's a shortcut. So that's 6 months: October, November, December, January, February, March, right? That's 6 months. So 6 month depreciation you have to charge on 1,58,000. So 1,58,000 into 0.10, 10% depreciation, right? So that's equal to 15,800. But can we take this? Of course not. We have to proportionate into 6 by 12. That's equal to 7,900. So 7,900 will be the depreciation on M2. So 7,900 minus 1,58,000, subtracting from the WDV, from the cost, that's it. That is 1,50,100. That is the WDV on the 31st March 2021 at the year end. Fine. So we have completed all the calculation. Yeah, we have now all the WDVs, all the depreciation of, all the machineries, and the profit and loss also we calculated. So this working note is really great in these questions when you have lots of machines and you have sold or purchased and all. Okay, as you go on purchasing, you have to keep on opening new columns for new machineries, right? And I have just broken this. Okay, so now the job gets really easy. You just can directly fill the information and do this. Okay, now I'm not doing this, okay, the case A, because it's really simple. You just do that by your own. I have already explained. This is case 1. Here the study mat has solved this through case 1. The provision for depreciation is not maintained now, so everything will be happening in the asset account itself. Okay, fine. This is case 1. Through case 1 they have solved this. Now let's see the case 4. See, here we have the ledger account. Let's understand how you have to do this practically when provision for depreciation account is maintained, and the study module has solved this through case 4. What is case 4? Did you forget? Case 4 is when you are maintaining provision for depreciation account or accumulated depreciation account, and then when you are selling off the asset, you are also opening a temporary account called as asset disposal account. That's case 4. Okay, now this question can be solved with any cases, right? Any cases, it doesn't matter. The question has asked you have to maintain this provision for depreciation account, so you can choose whether you want to open asset disposal or not. It's better to open. Okay, it's more practical actually. This is followed in real life. Fine. So see here, machinery account. In machinery account, what happened? In machinery account, first you purchase the machinery for 12 lakh on 1st April 2018. So let's just record that. Okay, machinery account is increasing because of the money which you paid through bank to purchase the machinery to bank account 12 lakh. Okay, that's all happened in that year. So immediately you will close this account, right, by balance C by D, and you will just double underline it and it's over. You don't need to find out the total and the balance. Directly you can do, because only two figures are there, 12 lakh, 12 lakh. Clear? Easy and straightforward. And then this closing balance 12 lakh will be taken over here as opening balance to balance B by D, 12 lakh. And then in this second year also nothing happened. Now nothing happened. See, in this year nothing happened. Yeah, here we are maintaining provision for depreciation, so we are not charging the depreciation in the asset account, so that will also not come. So nothing is there. So to balance B by D, it came on 1st April 2019 and the year ended on 31st March 2020. Nothing happened till that. So here directly it will be closed by balance C by D. Again, no totals, directly just two amounts are there, just two items and same are there. So just double underline it and close it off. Okay, to balance B by D, opening balance, closing balance, and it's over. Okay, right. Now this closing balance will be opening balance. Now this is the current year and lots of things has happened in this current year, so you have to go slow over here, right? So by balance C by D, this is the opening balance 12 lakh. Now what's happening? First thing is we have sold, right, M1 part for 45,000. But now what we have to do, what did I say? What you have to do? Here we are maintaining asset disposal. So whenever you are maintaining asset disposal, what you have to do is whichever asset you have sold, just take that asset to the asset disposal. Just reduce it from the asset account. So machinery account will be decreasing. It is getting credited. Okay, it is getting credited. It is getting credited because of asset disposal account by machinery disposal account 80,000. Now what is this? This is the original cost. You have to understand, this is original cost. This is not WDV, because machinery account will be at original cost now when you are maintaining provision for depreciation or accumulated depreciation, isn't it? That's what I said. Yeah, let me just show you the format once again. See, in the format I told you now, you will take the asset disposal at original cost, right? So this is at original cost. Fine, 80,000. And then you have purchased another machinery for 1,58,000, isn't it? So on the same date, 1st October 2020, 1,58,000 M2. So that will also be recorded. Machinery is increasing because of the money which you have paid on 1st October 2020 for 1,58,000. Is it clear? Simple. After this, what you have to do, you just have to balance. How will you balance? Really simple. See, 12 lakh plus 1,58,000, you all know that's 13,58,000. So write 13,58,000 on both the sides and then subtract 13,58,000 minus 80,000. 13,58,000 minus 80,000, that gives you 12,78,000. So this 12,78,000 is what? Closing balance. Is it clear? Do you understand this? Simple and straightforward. So machinery account is completely finished. Okay, from 1st April 2018 you came to 31st March 2021, all the transactions have been considered. It's over. Now let's see provision for depreciation account. In provision for depreciation account, what happens? You charge the depreciation over here, isn't it? You charge the depreciation over here and it keeps on getting accumulated, keeps getting combined as the time passes. Okay, you do not finish off the provision for depreciation. No, it gets accumulated. Is it clear? Yes. So in the first year you had to charge entire year depreciation. Let's go to our working note. Okay, let's go to our working note. In the first year, what happened? How much depreciation did you charge? Depreciation for 2019 was 1,12,000 plus 8,000. So that's equal to how much? 1,20,000. Yes, 112 plus 8, that's equal to 1,20,000. Yeah, so 1,20,000 depreciation you have charged in the first year. So that will come over here. See, provision for depreciation account is increasing. Okay, it's increasing. This account is increasing because of depreciation you have charged in the first year on that 12 lakh machinery, right? By depreciation 1,20,000. Now nothing else has happened, so this account will be balanced out. Okay, 1,20,000. here also 1,20,000 you will take, just double underline it because there is no other value now. So directly 1,20,000, 1,20,000, fine. So this is the closing balance. Now this closing balance will go and become the opening balance in the next year. 1st April 2019, buy balance brought down 1,20,000. Yes, you know that. And then in this year also you have to charge the depreciation. Nothing happened in this year. See, nothing happened now. See, nothing happened in this year. It's just that you have to charge the depreciation. So how much was that? Depreciation for 2020 was 1,08,000 plus 7,200. Let's just add it up. 1,08,000 plus 7,200. That's equal to 1,08,000 in total, right? So 1,08,000 depreciation you will be charging. Okay, we have bifurcated now, so that is why I have to add back and get that. Okay, so that will be equal to 1,08,000. You can see over here, right? Provision for depreciation account is increasing because of depreciation. By depreciation 1,08,000, 31st March 2020. Clear? Easy. And then you will balance this account. 1,20,000 plus 1,08,000, that's equal to 2,28,000. Yeah, see, 120 plus 108, that's equal to 2,28,000. So 2,28,000 on both the sides in the total column, and then here nothing is there, so that will be filled up by the closing balance. To balance carried down 2,28,000. Is it clear? Simple. You understood. Now this closing balance will become opening balance over here. Buy balance B by D 2,28,000. And now in this current year, what has happened? Lots of things happened, right? So we have to properly go slow over here, right? So see, the first thing is we have sold off the asset on 1st October 2020. So whatever depreciation has been accumulated of this part, you have to take that to asset disposal. How will you find that out? How will you find that out? How much depreciation has been accumulated of this part? That is why we have the working note. With the working note, you will be able to know how much depreciation you have charged up till now, up to the date of sale on the asset which you have sold. Isn't it? 8,000, 7,200, 3,240, right? So these are the depreciation you have charged up till now on the, up to the date of sale. So if you add up all of this, 8,000 plus 7,200 plus 3,240, you will get the total accumulated depreciation of this M1 part. So that much you have to take to asset disposal. So let's just add it up and let's see. 8,000 in first year, in the second year 7,200, in the third year 3,240. So that's equal to 18,440. So 18,440 value from accumulated depreciation account has to go to asset disposal. So accumulated depreciation is decreasing by this amount and asset disposal is also decreasing. Okay, understand? Let's see. See what will happen. Provision for depreciation has credit balance, so it is getting debited. It is decreasing by amount of 18,440. Where is this going? This is going to machinery disposal. Okay, you are de-recognizing, you are eliminating the provision, you are eliminating the accumulated depreciation. So to do machinery disposal account, 18,440. I told you now what will happen in accumulated depreciation account. Here asset disposal will come. What is the amount? Amount is the total depreciation you have charged on that asset till the date of sale. That's what it means, accumulated depreciation up to the date of sale. Fine, you got that. After that, what happened? After that, what you have to do is you have to charge the depreciation on remaining of the asset which you still have. Okay, so this asset is completely over. Yeah, this asset is completely over. Now on M1 you have to charge the depreciation in 2021 now 90,720, and here also you have charged 7,900. So these two depreciation will come over there, will come in this in that provision or accumulated depreciation account. See, provision for depreciation account. See here 1st October, sorry, here first we had to charge the depreciation now. We had to charge on the M1 part also. On the M1 part, this 3,240 we didn't record that, so M1 part 3,240 we have to record, right? After that we'll do the machinery disposal. Okay, so yeah, so opening balance we took, and then on 1st October 2020 depreciation has to be charged on the asset which you have sold, that was 3,240, isn't it? Yes. And then you will take to machinery disposal. It doesn't matter, it's on the different side, so it doesn't matter. We have already discussed this, right? So yeah, you know that. And then you have to charge the depreciation on remaining of the asset which you still have. 31st March 2021 by depreciation account 98,620. How did we get that 98,620? It's really simple. Just see in the working note. In the working note, if you see 90,720 plus 7,900, 90,720 plus 7,900, that gives you 98,620. Is it clear? This and this has been added, the depreciation for 2021, okay, on remaining of the machinery which you still have by depreciation 98,620. Clear? Now what you will do, you will just balance this account 2,28,000 plus 3240 plus 98,620. Just add it up and see how much it is. Okay, 2,28,000 plus 3240 plus 98,620, yeah, that's equal to 3,29,860, isn't it? 3,29,860. Now subtract the one thing which you have over here, machinery disposal, 18,440, so that gives you 3,11,420. So that's the closing balance. That's the closing balance of provision for depreciation account. Is it clear? Simple and straightforward. You understood now how it's happening. Machinery account is over, provision for depreciation account is over. Now you have to see machinery disposal account. What will be happening in machinery disposal? Simple and straightforward. This account came into existence with a debit, right? When you transferred asset over here, right? Isn't it? That's what happens now. Asset was transferred over here on 1st October 2020. Here see by machinery disposal of how much? Of 80,000. So this 80,000 has flown into asset disposal on the opposite side. It's always cross posting. It's really simple ledger accounts. Just do cross posting, you will be good to go. So to machinery disposal 80,000, it will come over here. Asset has come on the debit side, and then you will sell off the asset. Yeah, you will sell off the asset, but before that you have to take the depreciation, the accumulated depreciation. See, you have done now machinery disposal 18,440. So cross posting of that on the opposite side by provision for depreciation, or you can say by accumulated depreciation 18,440, isn't it? Yes. And then on the same date you have sold by bank also. Yeah, by bank also 45,000. You have sold for 45,000, and then the profit and loss is 16,560. How did we get all that profit and all? You have already calculated that in the working note. See, loss on disposal 16,560. Yeah, it was a loss, not profit. It was a loss, 16,560, and it was sold for 45,000. So all that has to be recorded. First you increase the machinery disposal account, right? And then you are decreasing the machinery disposal account. Is that clear? Simple. This 80,000 was there. Yeah, you found out how much depreciation has been charged on this 80,000. You took that over here. So you have got the WDV, and then you have taken the money which you have received by selling off the asset, 45,000. You found out that the difference is 16,560. The balancing figure will be either profit or loss. Now here in this case it is loss. This is what? This is loss. Okay, is it clear? Simple and straightforward. So this is how you have to do it. Okay, now this working note is not enough. Okay, if you follow this working note, then what will happen? Here you'll be need to making so much calculations, okay, at each of the years. It's better to do this calculation, really simple calculation. Okay, as you go on purchasing new machines, you have to make new columns, and if any part has been sold, then you have to bifurcate the machinery into the machine, the remaining machine, and the part. Okay, that's what you have to do, and separately charge the depreciation. You will be having how much depreciation you have charged in each of the years. You easily just add that up, you will get the accumulated depreciation, right? So this is how you have to do it. And whenever you sell, what you have to do, you just have to calculate the WDV on the date of sale, and then subtract the sale proceed, see whether you have loss or profit, and yeah, so that's how you have to do it. Fine, simple and straightforward. You understood this? Yeah. Okay, so that's it for this video. Okay, see you in the next video. Bye.